Hi everybody, this is Lara with your weekly video for the S&P 500 for the trading week ending Friday 20th of May 2022. And the S&P is now officially in bear market territory. It's retraced just over 20% of market value to Friday's low, not the close. Need another 49 odd points before, on a closing basis, it's in bear market territory. But I think we should be measuring the low, not the close. This week we had a 90% up day and then an 80% up day, but immediately followed by a 90% down day. So a little bit of flip-flopping. The 90% up day and 80% up day coming shortly after a 90% down day indicated a potential shift from bear to bull. But it hadn't occurred within full capitulation. Conditions weren't as extreme as they should be at the end of the bear run. And then that 90% down day negated the previous 90% up day, and we are remaining within bear market territory. And so the target remains the same, 3195. I will still have an alternate to consider the possibility that primary 2 may be complete at Friday's low. It has a low probability. Confidence would come with that if we see a new high above 4307.66. Elliott Wave analysis first, classic analysis last. This Elliott Wave count sees from the March 2020 low up to this last all-time high, a 5-wave impulse complete up here. It has a really good fit. Intermediate 1 is extended, 2, intermediate 3 is a very long extension, 4 and a short intermediate 5. This is now being followed by a zigzag to the downside, intermediate A. Intermediate B is an expanded flat. That's a very common structure for B waves. And now intermediate C continuing lower and breaking below the lower edge of an Elliott channel drawn around primary 2, drawn from the start of A to the end of B with a copy, well, I should be putting it on the end of A, but I'm going to put it down here on the end of minor B. Prices closed below the lower edge of this channel at the end of the week, and that's pretty normal behaviour for C waves. C waves are in a third wave position, a 1, 2, 3, A, B, C. Being in a third wave position, they can have similar behaviour to third waves. They can be particularly strong. My target for primary 2 to end is the 0.618 Fibonacci ratio at 3195.28. Primary 2 may not move beyond the start of primary 1 below 2191.86. Let's take a look at the daily chart where the high of primary 1 is this point here. Now we're looking at the structure of primary 2, a zigzag, impulse for intermediate A, expanded flat for intermediate B, impulse for intermediate C, extending. An extended first wave, a brief shallow second wave, and now a third wave beginning may only subdivide as an impulse. The shorter term target is for minor 3 to reach 1.618, the length of minor 1 at 3377. Within the impulse of minor 3, minute 1 and 2 may be complete, and I think minute 2 probably is complete, finding resistance at the upper edge of this best fit channel. I've drawn the channel from the end of minor 1 to this low here, placed a copy up on the end of minor 2. While minor 3 is underway, I would expect bounces to find resistance at the upper edge of this channel. If, however, minute 2 is not over, it may not move beyond the start of 1 above 4307.66. This is a rather conservative invalidation point. I want it to be, because if we see a breach of this price point, we can have quite a lot of confidence that there has indeed been a big trend change. So I think erring on the side of caution is probably a better idea for those purposes. The target for primary 2, the same as from the weekly chart, that'll reach the 0.618 Fibonacci ratio of primary 1 at 3195.28. At the daily chart level, I will still try and have an alternate that's very bullish, but if the very short term is invalidated for the main wave count, I really would want to see a new high above this price point, 4307.66. We need to see a new high above that point, not on a closing basis, any point on any time frame, even a fraction of a point on a tick chart is enough to give us confidence in this wave count above 4307.66. It's possible still to see primary 2 over at these lows, first zigzag and a double, complete here, a 3 in the opposite direction joining the first and second zigzags in a double, and a second zigzag labelled intermediate Y could be complete here with a very, very long wave A, B, C. I tried to see a better way of labelling this, but I just couldn't really get the subdivisions to fit any other way where A and C are closer to equality. So A is very, very long in relation to C here. That slightly reduces the probability of this wave count. They don't have to be equal in length, but the closer they are to even in length, the better the looking the wave count. Sometimes one or the other is extended, and that may have been the case here. If this is correct, then within primary 3, no second wave correction may move beyond its start, below 3810.32. And a reasonable target for primary 3 should be for it to reach at least 1.618, the length of primary 1. The S&P has a very strong bullish bias and a really strong tendency to very long extended third waves. So despite the second wave only reaching the 0.382 Fibonacci ratio of the first wave, I would still, for this market, want to use 1.618 to calculate a target for primary 3, and that gives us a very high target at 8060. Okay, classic analysis now. At the weekly chart level, more downward movement this week, a decline in volume this week, but overall volume is still increasing and volume does remain heavy. There's a bullish long lower wick, but there's also a bearish upper wick. So these wicks are close to even, so I'm not going to read it bullish or bearish either way. May see resistance now about 3980. Now price is closed below that this week. Look out for next support below about 3600. The last signal from on balance volume was bearish. RSI still not oversold, still in neutral territory, just. If it does get oversold, it tends to not remain there very long. It can, in a really strong bull market, get quite deeply oversold. I spent a little bit more time looking at the global financial crisis from 2007 to 2009, and it can reach fairly deeply oversold, and price can travel a reasonable distance. But there's some weakness so far in this downward movement, although we have had 7 weeks in a row of red candlesticks, which is statistically speaking unusual. So we should be looking out for a green candlestick or doji to interrupt this sooner rather than later now. ADX indicates there's still a downward trend. It's not yet extreme. There is room to go before this market is in extreme territory. We're not there yet. Room below for price to fall. Stochastics oversold, but we use RSI, not stochastics, when the market is trending, and ATR continues to increase, which is absolutely normal for this market when it's in a bear market. At the daily chart level, at the end of the week, we have a hammer candlestick pattern. This is a bullish reversal pattern. It has not come in the context of an extreme trend though, so it may be more likely indicating a short-term bounce or consolidation rather than full 180-degree reversal. Because ADX is at the daily chart level not extreme, and RSI is still reasonably in neutral territory, there's actually on a closing basis just a little bit of bullish divergence between price closing here and from the close here and the close here. I'll just draw it across the lows because it's more visually intuitive, but I haven't put it in because it's just so weak and it hasn't come after RSI reached oversold. But I just wanted to note that I am aware it's there, and this is why I'm not putting it on the chart. Stochastics entering oversold, ATR increasing as price falls. That's normal behaviour for this market. So there's a downward trend. It's a bear market. It's not yet extreme. We had this 90% down day here, followed shortly after by a 90% up day, indicating a possible V bottom falling. And then a couple of sessions later, an 80% up day added a little bit of confidence to that view. But it was then immediately followed by a strong 90% down day, which negated this prior signal. So back to bearish territory. What about breadth and volatility? Again this week, the AD line has made long-term new lows, and price still has not made new long-term lows. There is bearish divergence for the long term here between price and market breadth. Breadth is falling faster than price. We read breadth as a leading indicator. Where it leads, price usually follows, and so I will still expect more downward movement overall for the bigger picture. For the short-term picture, a little bit of bullishness here. We may see a little bounce or consolidation beginning early next week. The AD line has failed to make a new low below price, which on a closing basis, although I'm going to draw lines across the lows because it's more visually intuitive, but I am checking the closing prices to make sure that there is actually divergence before I put these lines on. Price has made a lower low. The AD line has failed to make a corresponding low. For the short term in this downward movement, there's a little bit of weakness. Price is falling faster than breadth. This is bullish for the short term. And between price and the Nasdaq AD line, there is a little bit of short-term bullish divergence. Price has made a lower low. The Nasdaq AD line has failed to make a corresponding low. So this is bullish for the very short term. It's only short term. There is still, for the much longer term, very strong bearish divergence which has not been resolved. By resolved, I mean price and the Nasdaq AD line should be making lower lows. So the Nasdaq AD line has been making very strong lower lows. Price has not made corresponding lower lows for the long term. There is long-term bearish divergence here. If price manages to make lower lows below the same prior point in time, then we can say the divergence would be resolved and we may be looking at the end of the bear market. That situation has not been resolved. This is a very bearish chart supporting a bearish Elliott Wave count. What about volatility to round out the picture this week? For the very short term, again, a bullish signal between price and inverted VIX, but they just haven't really been very reliable. We had one this week here, and now this week, and yet price has been falling, so I'm just not going to give it much weight. This week, price has moved lower. The inverted VIX has moved a little bit lower. No new short-term divergence here. But between lows on a closing basis, inverted VIX has not made a short-term low, whereas price has made a new short-term low. This divergence is bullish for the very short term. But again, I'm just not going to give it much weight. It hasn't been that reliable recently. Between VIX and VVIX, this week VIX has increased, but volatility of VIX has declined. With volatility of VIX declining for the very short term, this is bullish for the very short term. And for the very short term on a daily chart level, we see this divergence between swing lows, between inverted VIX and price. Price is falling, but VIX is not increasing as fast, or volatility is not increasing in line with the fall in price. This divergence is bullish for the short term for price. Between VIX and VVIX for Friday, VIX is essentially flat. Volatility of VIX for Friday increased slightly. This is bearish for the very short term for price. So some mixed messages there. That's all from me with your S&P analysis this week. I hope our members are looking forward to an awesome weekend.